When you're investing in crypto, your biggest enemy might not be a market crash. It might be your own emotions. Or it could be a game that's, well, rigged from the very start. Today, we're diving into that razor-thin line between disciplined investing and straight-up deception. Let's get right into it.
We've all seen this phrase, right? Prices are tanking, your portfolio is a sea of red, and every corner of the internet is yelling one thing: buy the dip. It's so tempting. It feels like this golden opportunity, a chance to be the hero of your own story and scoop up a bargain. Okay, but we have to hit the pause button and ask ourselves, is this actually a smart, calculated move, or is it just a high-stakes roll of the dice? Because let's be real, trying to perfectly time the absolute rock bottom of a crash, it's basically impossible. And most of the time, it just leads to a ton of stress and frustration. And this slide just leads it all out perfectly. Over on the left, you've got that chaotic, gut-wrenching feeling of FOMO. You're reacting to every little price swing, you're stressed out. But on the right, that's disciplined patience. You're calm, you're sticking to your plan, and you're just tuning out all that noise. One is pure emotion, the other is a real strategy. So the big question is, how do you get from that emotional side to the discipline side? Well, let's talk about a really simple but incredibly powerful strategy that takes all of the guesswork out of the equation. It's called dollar cost averaging, or DCA for short, and the idea behind it is brilliant in its simplicity. You just invest a fixed amount of money on a regular schedule. Maybe it's $100 every Friday, doesn't matter. When the price is high, your money buys a little less, but when the price is low, your same $100 buys way more. See? At the end of the day, consistency beats trying to be a psychic. All right, let's actually put this to the test. Imagine we have two investors. We'll give them both the exact same amount of money, $1,200, to invest in Bitcoin, and we're going to watch them over 6 super volatile months. So check out these numbers. Our DCA investor just plugs away, putting in $200 every single month, no matter what the price is doing. But our dip buyer, they're waiting on the sidelines, trying to catch that perfect moment, and they end up throwing all their money in at the very end. But look at that key metric, the average cost. Our DCA investor paid way less per coin on average. And here's the punchline. At the end of those 6 months, our disciplined DCA investor has made nearly double the profit of the emotional dip buyer. It's just proof that a steady, unemotional plan can really pay off, literally. So the huge takeaway here is that when you have a disciplined process like DCA, all that crazy market volatility stops being your biggest enemy, and it actually becomes your best friend. You're not trying to predict the future anymore. You're just focused on what you can control, your own consistent actions. But what happens when you finally get your own emotions in check, only to find out that the game itself might be rigged? This is where our story takes a really sharp and kind of dark turn. Because having a great personal strategy, that's only half the battle. Okay, so we're shifting gears now. We're moving away from your personal mindset, and we're going to zoom out to look at the market itself. And what we're about to uncover is a practice designed specifically to fool investors, just like you. It's called wash trading. And to put it simply, it's just faking trades. You have one person or a group just buying and selling the exact same asset to themselves over and over and over. And why would they do that? To create this illusion of huge trading volume, to make it look like there's massive demand for something, tricking everybody else into thinking an asset is way more popular than it actually is. And here's the thing, this isn't some conspiracy theory. The amazing part about crypto is that so many transactions are public, right on the blockchain. And that means researchers can actually go in, follow the money, and create specific filters to hunt down and identify these fake trades. For instance, one academic paper laid out these 4 clear red flags. First, this super obvious one. The buyer and seller are literally the same wallet. Then you've got 2 wallets just playing catch, trading an NFT back and forth. Then there's more complex patterns. But this last one, this is the really clever one. They look for trades where the buyer's wallet and the seller's wallet were both funded by the exact same original source. Gotcha. So if we can actually spot this stuff happening, then just how much of it is there? Well, you might want to sit down for this because the numbers are genuinely staggering. This research discovered that on major NFT exchanges, a mind-blowing 38% of all trades were likely fake. Just let that sink in. More than 1 out of every 3 trades you see flashing on the screen might be completely fabricated. But hold on, it gets even crazier. Because when you stop looking at the number of trades and start looking at the actual dollar value being moved around, those same fake trades made up 60%. 60!
That means the majority of the money that appears to be flowing through these markets is just an illusion created by people trading with themselves to paint a totally false picture.
So why would anyone go to all this trouble? Well, the reasons are pretty simple and pretty cynical. You can make your NFT collection or your whole exchange look way more popular than it is. You can artificially pump up the price to lure in real, unsuspecting buyers. And sometimes you can even game the system to earn platform rewards or royalties from your own fake activity. Okay, so this leaves us in a tricky spot, right? We have the personal strategy that we can control, and then we have this market reality that we can't always trust. So let's tie this all together.
And this slide really is the perfect summary. It's the two sides of the coin. On one side, you have your strategy, your discipline, your consistency, your DCA plan. And on the other side, you have the market's reality, potential manipulation, fake volume, and wash trading. To really succeed, you have to nail your own strategy while keeping your eyes wide open to what's going on in the background.
Look, the goal here is not to scare you away from crypto, not at all. It's about empowering you with knowledge, because knowing that this deception exists makes your personal discipline, your research, your patience, your DCA strategy that much more critical. It's your best defense, it's your shield in this whole game. So we'll leave you with this to think about. In a game that might have hidden players and moves that aren't even real, is the discipline you bring to the table the only true advantage you really have?